Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from the U.S., Korea, and around the world. We are coming to you live from the floor of the New York Stock Exchange, and I am your host, Remy Blaire. We are coming to you live from the financial capital of America in New York City. We'll start out the hour with the market briefing and live coverage of the U.S. markets. For today's market briefing, we have Tai Wong, independent proprietary trader. And in the second half of the show, we'll be bringing you a special segment with Howard Marks of Oak Tree Capital. Good morning, Tai. Thank you so much for joining me today.
Good to be here again.
Well, we were here this time yesterday and we saw markets in the red. And in today's trading session, we're seeing mixed trading for the major equity averages. This does come on the heels of PPI figures, producer inflation figures, and jobless claims. But first and foremost, what did you make of the volatility yesterday? Because we did close higher.
What a day. I mean, I think we sat down and the Dow was down 750 points. I think by the time we finished, the Dow was only down 500 points, and it really slowly, methodically clawed its way back for what resulted in a very good day, led by big tech, led by NVIDIA, which was up over 8%. And it seems that the U.S. stock markets will take a punch, but they're indomitable. They just keep coming back. So really a remarkable price action. And what is important about that, if you're a chartist, you'd see that we may be poised for perhaps a new high in the S&P 500. If the Fed is cooperative next week, which is to say that they'll give us 25 basis points and give the market something they want to hear, something soothing, perhaps a dovish outlook. Unclear what that's going to be, but it sets up the S&P very, very well.
And speaking of the U.S. stock averages, Tai, let's take a look at where markets are this morning at the 11 o'clock hour. So in New York morning trade, we're seeing the Dow Jones Industrial Average lower by 0.2%, and the NASDAQ Composite Index is slightly higher on the session, up by 0.2%, but we are seeing flat trading for the S&P 500. Right now, we are seeing the S&P 500 at the 55 level. And as you mentioned, Tai, next week we have the Federal Reserve rate meeting. They kick off their two-day meeting on September 17th, and on the afternoon of the 18th, we get that rate announcement. But while we're on the topic of central banks, I do want to take a step back because the ECB this morning, they cut as expected by 25 basis points. And in addition to that, they did lower their growth forecast. So what did you make of that rate announcement?
So that was perhaps the most well-telegraphed thing we've ever seen. But we laughed because 68 out of 68 economists said they were going to cut 25 basis points.
Very accurate.
Completely unanimous. So they're telegraphing better than the Federal Reserve. Boy, the Fed likes to not surprise the market, but I guess these folks definitely feel the same way. So they have a little bit of a conundrum, and they're literally going meeting by meeting, because even though inflation is coming down, they found that inflation is coming down, but wages are going up, and wages that usually will start hitting inflation with a little bit of a lag. So there's concern, particularly about services. So they're literally going meeting by meeting. Most economists think they will not move in October, but might move again in December if the wages stay reasonably quiescent. But we're not sure. And then back to, you mentioned a little bit earlier about PPI and our data this morning.
Inflation.
PPI's has been quiet, but generally was higher than expected today, both headline and consensus by a tenth. But the revisions to last month were lower. So essentially, it was a flat reading. Jobless claims, initial jobless claims, pretty steady around the 230,000 initial claims mark. So I think the market essentially is now probably 90% that we're going to get 25 basis points. They're going to try to think about what Jay Powell is going to say, but I think that we're pretty much set in stone in terms of at least the rate move next week.
And while we're looking at inflation figures, I do want to take a step back and look at those CPI figures that came in yesterday. So mostly in line with estimates, but we did see shelter costs or housing inflation in those figures. So when we were talking about this before the show yesterday, we were talking about mortgage rates as well. So Tai, tell us what's happening in terms of mortgage rates here in the United States.
So the average mortgage rate, I think it came out yesterday or the day before, it's 6.29%, and it's a drop of maybe 15 basis points from the week before, and it's the 7th straight week, I think, that the rates have dropped. So, which is really good news. And as a matter of fact, just on a call yesterday, somebody said that a 30-year 5.75% mortgage has gone through, which is quite remarkable because I think most people don't remember the last time they saw a 30-year mortgage with a 5 handle on it. So that's pretty encouraging. Which just brings us to the housing market. One thing about the housing market in the past couple of years that's really surprised people is historically, with higher rates, you get lower housing prices because mortgages are more expensive, so housing it's harder to sell. But what happened in this case, and something that I can't remember seeing, is that because the rates went up so quickly, anybody who currently owned or currently owns a house didn't want to sell their house and buy something else because they'd be trading in. I'm lucky; I have a 3.75% mortgage. If I trade that in, my new mortgage on my new house, if I wanted to upgrade or even downgrade, unless I could pay for it in cash, would be 6.5%, 7%. Who would do that? So you had a situation for a couple of years where rates are very high, but prices are very high because there's no supply on the market. So I think we may hopefully be seeing that market sort of freeze, I guess, slowly melt down a little bit, where you get a little more supply, where people can afford to buy a new house. First-time buyers can afford to buy a new house, and existing owners can upgrade to a house at a reasonable rate. We're not there yet, but we could see it if rates continue the way that they go. We could see it perhaps closer to the end of the year, and certainly by the spring selling season.
And Tai, I'm so glad you went into the dynamics of the housing market, because when we think about buying a house or buying a property here in the U.S., rates are key, mortgage rates. And typically in the U.S., you and we spoke about this yesterday before the show, but we have rates at 15-year or 30-year when we're talking about these rates. But when it comes to pricing, these are fixed, correct, versus variable here in the United States?
In the U.S., most mortgages are 30-year fixed, although you can get a 15-year fixed if you wanted. And the great thing about the mortgage market here is you can prepay, which means generally you can, if you came into a lot of money, you could just pay off the mortgage. Or if you sell your house, you get rid of the mortgage and you can prepay that, which is great for the consumer. And as well, in this mortgage market, you can refinance. I remember my original mortgage was higher, but I refinanced probably 1.5% lower, and I've held that. I'm never getting rid of that mortgage, especially if I can get, well, not for much longer, but if I can get sort of 5% in a CD or in a high yield savings rate. And I'm only paying 3.75% of my mortgage. Why would I ever touch that? Thing is staying forever. I'm going to pay that down to the last possible date. Some people use ARMs, where adjustable rate mortgages, and they often come in 1.5s or 1.7s, which means that they are adjustable. They're adjustable for up with every year, but usually with a ceiling. It can't go up more than 2 years. And they're 5 or 7 year mortgages, but those can be a little more risky, and nobody's doing those these days because the initial rates are so high. I think people do that when rates are very, very low, thinking that we'll take advantage of. What they'll do is they'll give you a low teaser rate to start, but then they have the optionality to raise that if markets go up. In other countries, you don't really have the 30-year fix like we do. I think in Canada it's a little bit different, and the Canadian housing market has had an issue with, because mortgages are so short and people had trouble paying for it, they're sort of extending and praying, and hopefully the market comes back where homeowners who are underwater can continue to pay it. So we're very lucky in this country.
And a 3 mortgage rate, that is something, 3 handles, something that we haven't seen in several years. And we know here in the U.S., when it comes to the housing market, during the pandemic and post-pandemic, we have seen such a sea change in the way that consumers buy shelter or buy housing and property as well as rent. So we'll see how inflation as well as the change in interest rates starts affecting the housing market in coming months. So
I think it will be a long time, if a long time. I hate to say if ever, that we'll see a 30-year mortgage with a 3 handle on it. I do think, and a lot of economists feel the same way. I mean, they feel the same way.
Yeah.
They're much better at this than I am, to be perfectly honest. But that the underlying level of inflation, we used to struggle to get 2% from the downside. It'll be a lot harder for us for a number of reasons to get back to it from the upside now that we may stay between 2.5% and 3% on inflation. One of the reasons is the changing demographics of the country, but the other is we're trying to go for a greener economy, electric vehicles, and all of those things are relatively expensive. So on a broad spectrum, you can easily see how that adds perhaps 0.5% or 1% to underlying inflation.
And we'll have to keep an eye on those numbers, Tai, but it does make me think when it comes to housing as well as EVs, these are issues that are on Americans' mind in this presidential election cycle.
Well, you're absolutely right, because one of Vice President Harris's proposals is to give a $25,000 tax credit. I forget if it was a tax credit or a down payment to first-time home buyers, which sounds great. But if you think about that, if the seller of the home sees, well, they're getting another $25,000, down payment, I think I can probably raise my prices a little bit. So you could, it's sort of the law of unintended consequences, which is really, really powerful. And for those of us in the market, we really respect it, because you touch something and you think something will happen down the road, but you never know how those waves broaden out. So will it boost home prices just when we're hoping that the housing prices ease a little bit to get transactions moving again and people into homes, because that's a big driver of the economy. Right? So you don't really want to maybe mess too much with that. But it's important, and that's why I think she proposed it, because on the face of it, it's great. If you gave me $25,000, that's awesome. And I mean, I guess there's a truism in politics that if you rob Peter to pay Paul, you're pretty much guaranteed the support of Paul. But housing is an issue. That's why the governors and mayors, as well as the presidential candidates, are focusing on it.
And absolutely, because you think about different markets, real estate markets, whether we're talking about commercial or residential here in the U.S., and $25,000 here in a market like New York City or the major metropolitan areas versus other areas that may be suburban or rural, that can go much further.
You're absolutely right. You're absolutely right. I remember, now it's a few years ago, and prices have gone up since then, but Senator Schumer, Majority Leader Senator Schumer of New York, said, no, in New York City, if you're living in New York City, if you make $200,000 a year, you're just making it.
Yes,
and
that's unbelievable, isn't it?
Isn't it? Isn't it? An apartment, a one-bedroom apartment in a nice condo building in New York City, $5,000–6,000. Those are remarkable numbers. So $25,000 perhaps not meaningful here in the tri-state area, meaningful a lot in various parts of the country.
And if you're in a co-op or a condo here in New York City, you have to think about HOA fees or additional fees to that. So that does add more to the total. But moving away from housing, Tai, I do want to very quickly take a look at other markets, including oil, metals, as well as the U.S. currency. So yesterday we saw the yen rise, and today we have the ECB rate decision. So what are we seeing on the heels of today's rate announcement?
So euro dollar barely moved. I mean, literally, I think it moved what they call 10 pips, which is practically nothing. When the announcement came out, and dollar has been relatively quiet. Bonds are a little lower, yields are a little higher, bonds a little bit lower today. And oil is up for the second day in a row, and this is I think we may have touched upon it yesterday, but the Russians, or President Putin, came out and said we may consider. I'm sorry, might have been Putin's lieutenants said that we may want to punish the world by cutting back on some of our commodity exports, which the world needs, but we don't want to hurt ourselves. They mentioned uranium. I think they mentioned natural gas, but certainly oil was on people's minds. Palladium was on people's minds, and palladium has rallied very, very sharply. It's a metal that's used in catalytic converters. So everybody who has a gasoline engine has palladium in the catalytic converter in their car, and that rallied probably 7 or 8% over the last few days. So I think that that announcement may have gotten out a little bit ahead of time. The one thing I do want to focus on today is gold.
Yes.
Gold has gone up to a new high, a new historic high, trading about $2,550, and there's really no single trigger on it. In the sort of relatively early, more around 9 o'clock or so, we just saw a big volume build up in gold. And what that suggests for someone who's been watching the market for a long time is that there's program buying. So today, if you wanted to buy a lot of gold, if you wanted to add it to a fund, in the old days you would probably call up a salesperson for a bank, and the salesperson would go say, Tai, where are you in 100,000 ounces of gold? And I'd make a two-way price because I wouldn't necessarily know which way they're going, though depending on who the customer is, I might, and I would make a price. But today they would say 100,000 ounces of gold. Well, we can buy that over, there's no rush, we can buy that over the course of an hour. So if there's 60 minutes an hour, and they just literally slice it and dice it up. So you just get sudden, unexplained, higher volume buying. And that's what we saw in gold. So it really feels like somebody's added to an allocation. And and the dollar really hasn't moved. Yields are actually a little bit higher, I think. So gold shouldn't have reacted on this on its own. So there's definitely a program in there, and it's a bull market. There are only really two allowable positions. You're either long or you stand aside, but there's no point in being short here.
And very quickly, since you mentioned yield, we've been focusing in on the yield curve, and tell me what's going on there, because there are concerns about the disinversion, and then right now, what is actually happening here? Are you concerned?
Not concerned right now. The disinversion in the past has in recent times has signaled the beginning of a recession, but that has not always been the case. And in the early 80s, we had a couple of the early to mid 80s, we had a couple of cases of disinversion where the markets and as a proxy for the economy has actually done very well. And you could say the early 80s was a time of substantial inflation, and we have been in a time of substantial inflation. So remains to be seen, but I think we may be okay.
Okay, well, very quickly, since we're short on time for today's segment, Tai, I do want to touch upon a story that we have been talking about. So bankers have had to turn in their passports in China. So what is going on here when it comes to that nation and these bankers?
So it was sort of an amazing headline, especially for Americans who are used to individual liberty. And if you look at it, we have actually more liberty and more absolute freedom of speech than I think exists anywhere in the world. Western Europe, where you can't criticize certain faiths and religions, but we can practically say anything we want about almost anything that is not, unless the financial sector, and the idea that Xi Jinping, Premier Jinping says, we want common prosperity for all, and it's easy to target people who are rich and have luxuriant lifestyles and have a lot of money. So he's cutting their pay and investigating them. One of their biggest deal makers hasn't been seen in months, and he's cooperating with authorities. And the broader theme of things, when you see things like that, it makes it harder to get the economy going in China again. He said, you have laws like this on one hand, but on the other hand, Xi says, hey, we want to do everything you can to make growth hit our 5% target. You're trying to run in two directions at once. You're not giving the market any confidence. And when a market's not confident, they don't want to do anything. And there was another story where the Wall Street Journal reported that U.S. companies where China is a top destination is down to 15%, and that's the lowest in a 25-year survey. So certainly American companies are still in China, but they're not looking to make any additional investments in China because of the sort of the business climate there. And things like taking away people's passports. Do people even want to be in the finance business? If you're in finance, do you want to be stationed in China or in Hong Kong for that matter? So this is something I think they will have to come to grips with if they do want to resume the growth that they had been used to. But what you're seeing is just really not helping. The headlines are, and certainly, with the Western press, it's not really friendly to China, but the headlines to China are simply not friendly. I mean, we had a scandal last week where a top aide to Governor Hochul of New York and Governor Cuomo before him turned out to be a highly paid agent working for the Chinese government. Now, listen, everybody has spies or everybody has agents in there, but that was a little close to home, and this is what people remember. So I think China needs to figure out what they want to do strategically.
Well, Tai, we are all out of time for today, but I look forward to speaking with you tomorrow, and we will see how the market closes today. Thank you for joining me.
It's been an interesting week.
Thank you. And coming up, Howard Marks of Oaktree Capital will be joining us. We'll be right back. Don't go away. Welcome back to Global Money Talk. For today's Market Insight, we're bringing you a special segment with Howard Marks of Oaktree Capital. Many of you know that Howard Marks is a regular guest on Sampro TV, and we're excited to share this interview that was just released by Oaktree Capital this morning. Also later this month, we have our very own Global Money Talk interview with Howard Marks. Coming up, be sure to subscribe to our channel to make sure that you don't miss it. And now, without further ado, here's Howard Marks.
Hi, I'm Howard Marks, and this is How to Think About Risk. The title of this class is How to Think About Risk. That's an important title. Not what to think, how to think. The first question is, what is risk? Risk, in my opinion, is the ultimate test of an investor's skill. The return alone doesn't tell you how good a job the manager did. The key question is, you see the return, you must ask, how much risk did the manager bear to get that return? Now let's look at this range of managers. What we posit is that the market is up 10% or down 10%. Now let's look at some individual managers. The first one is up 10 when the market's up 10 and down 10 when the market's down 10. Accomplishes nothing. You might as well have invested in an index fund that emulates the performance of the market. no skill, no value added. Now let's look at the second one. Up 20 when the market goes up 10, down 20 when the market goes down 10. No skill, no value added, just a lot of aggressiveness. Well, what about this one? Up 5 when the market's up 10, down 5 when the market's down 10. Again, no selection ability, no discernment, no value added, just defensiveness. You don't need help in achieving that, and you sure shouldn't pay a lot for it. But what about the next one? He or she is up 15 when the market's up 10, and down 10 when the market's down 10. So in other words, market type losses on the downside, but superior gains on the upside. Value added, what I call asymmetry, does better in the good times than does poorly in the bad times. But what about this one? And I think this is the most interesting, and I think maybe it characterizes me, maybe it characterizes Oaktree to some extent. Up 10 when the market's up 10, down 5 when the market's down 10. So market type gains in the good times, I personally think that performing with the market when it does well is good enough. And that's almost all the time. Nobody should have to beat the market when it does well. But if you can do that and at the same time be ready to decline less when the market has its down spells, I think that's accomplishing something very important. I believe that risk is not volatility. The academics developing investment theory, largely at the University of Chicago in the early 60s, just a couple of years before I got there, adopted volatility as their measure of risk. I believe they did so largely because volatility is readily quantifiable and nothing else is. I think that volatility can be an indicator of the presence of risk, a symptom, if you will, but it's not risk itself. So if risk is not volatility, then what is it? And in my opinion, and in the real world sense, risk is the probability of loss. I think this is what most people mean when they say risk, and I think that this is what people demand compensation for if they're going to bear it. Nobody sitting around at Oaktree says, well, you know, we shouldn't make that investment because it might be volatile, or because it might be volatile, we should demand a higher return. No, they say that about the possibility of loss. We're not going to make that investment because the possibility of loss is too high, or because of the possibility of loss, we're going to demand a risk premium in terms of the return. This is risk, the possibility of loss. Now, another important question is risk quantifiable in advance? And I believe it's not. Like most things occurring in the future, risk cannot be anything except a matter of opinion. I was writing my first memo about risk in 2006. I wrote about my belief that risk is not quantifiable in advance. And then I hit the return key and went on to the next section and wrote something I had never thought about before. My belief that risk is unquantifiable even after the fact. And I think this is a fascinating topic. You buy something for $1, and a year later, you sell it for $2. Was it risky? And the interesting thing is that you can't tell from the outcome. A profitable investment may or may not have been risky. Was it a safe investment that, in the case of my example, was sure to double? Or was it a risky investment where you got lucky in terms of the outcome? And as I say, you can't tell from the outcome. The bottom line is, to me, it's impossible to quantify risk in advance or even in hindsight. The possibility of loss is not the only form of risk. There are lots of forms of risk. My last memo on the general subject, it's called Risk Revisited Again. And I talk in there about 24 or 25 different forms of risk, some serious, some facetious, some important, some less important and obscure, but still it comes in many forms. The risk of missing opportunities is another important risk. In other words, if you think about it, the risk of not taking enough risk. Another really important form of risk, I think one of the key risks in investing, is the chance of being forced out at the bottom. Which is a bigger mistake? buying at the high and seeing a decline, or selling out at the low and missing out on the recovery? Clearly, it's the latter. If you buy at a high and you experience a decline, if you're able to hold throughout and not lose your nerve, the next high is usually higher than the last high. The fact that you experienced a downward fluctuation might have been uncomfortable for a little while, but by the time the new high is achieved, you're back to your cost and more. But if you sell at the bottom and miss out on the subsequent recovery, that means you've gotten off the track of investing and may never get back on. In my opinion, selling at the bottom, it's the cardinal sin in investing. Now I want to get a little philosophical. One of my great heroes, Peter Bernstein, probably the best thinker in a philosophic sense and a real investment sage who sadly passed away around 2009, once said, essentially, risk says we don't know what's going to happen. We walk every moment into the unknown. He said there's a range of outcomes, and we don't know where the actual outcome is going to fall within the range, and often we don't know what the range is. So in other words, we have ignorance to varying degrees about what the future holds. And it is from this ignorance that risk ensues. If we knew what was going to happen, by definition, there would be no risk. In the memo that I mentioned before, Risk Revisited Again, there's a great quote that I got from a Peter Bernstein memo. And I thought it was so important that I took it over word for word in my memo. It's from G.K. Chesterton, who was an English writer, and he said the following, and I'm going to give it to you word for word because it's so important. The real trouble with this world of ours is not that it is an unreasonable world, or even that it is a reasonable one. The commonest kind of trouble is that it is nearly reasonable, but not quite. Life is not an illogicality, yet it is a trap for logicians. It looks just a little more mathematical and regular than it is. Its exactitude is obvious, but its inexactitude is hidden. Its wildness lies in wait. In other words, we know what's likely to happen. We know the other things that probably could happen instead. We have little appreciation for the things that are highly unlikely to happen, but could. And these are what we call in modern day terms the tail events. My friend Rick Kane once said that 96% of financial history has occurred within 2 standard deviations, but everything interesting has happened outside of 2 standard deviations. That's the wild part. So now let me try, in a slightly philosophical sense, to reflect to you how I think about risk, how I think you might consider risk, through 4 basic points. Number 1, there was a professor at the London Business School who said, risk means more things can happen than will happen. For most events that lie in the future, there are a number of things that could occur. We don't know which one it will be. That's where the risk comes in. More things can happen than will happen. Number 2, as a result of that, the future should be viewed not as a fixed outcome that's destined to happen and capable of being predicted, but as a range of possibilities, and hopefully, because you have some insight into their respective likelihoods, as a probability distribution. The most likely, the less likely, the unlikely, but not impossible. Number 3, it's important to accept that even when you know the probabilities, that doesn't mean you know what's going to happen. This is something that I think many people fail to grasp. I play a lot of backgammon, and a lot of my examples on risk and uncertainty come from the game of backgammon, which is played with a pair of dice. And when you roll your pair of dice, we know exactly in advance what the probabilities are. Each die has 6 sides. There are 36 possible combinations of the 6 sides. We know how many of them, for example, will add up to 7. And 7 is the most likely single outcome. 1, 6, 2, 5, 3, 4, 4, 3, 5, 2, 6, 1. There are 6 possibilities out of the 36 that will give you a 7. That's the most likely outcome. 6 out of 36, that's 16.7% probability. Now, what if instead you want to know about a 6? Well, with the 6, there are 5 possibilities. 5 possibilities out of 36, that's a little less than a 7th. And then when you get down to the number 2, there's only 1 out of 36. And for the number 12, only 1, 6, 6, 1 out of 36. Both of those are about a 3% probability of happening. So we know exactly what the probability distribution looks like. We know what's the most likely, the other likely possibilities, and the unlikely possibilities. We still don't know what's going to happen. So knowing the probabilities does not eliminate the uncertainty. I work with a professor at Wharton named Chris Getze, and the way he put it to me one time, we live in the sample, not the universe. In other words, the universe statistics, like I just explained for the dice, determine the things that could happen and maybe their possibility. But we live in the sample. We only have one outcome, and therein lies the uncertainty. A great way to think about this is on Super Bowl morning in 2016, they had a former football player on, and he said what I thought was one of the smartest things about probability I had ever heard. This game was Denver versus Carolina, and Carolina was heavily favored, and they asked him who he thought would win. And he said the following: Carolina wins 8 times out of 10. This could be one of the two. Now, this gives you the essence of probability and the essence of risk. Most people, if they hear that something's 80% likely to happen, they say, well, then I guess we know what's going to happen. I guess they might as well not play the game. No, 80% likely means that the other team should win 1 game out of 5. So we have to play the game because we have to figure out which game this will be. And that leads to number 4. I take Dimson's statement that risk means more things can happen than will happen, and I turn it over. Even though many things can happen, only one will. Thus, the expected value, the probability weighted average of the possible outcomes, which is the basis on which people make many decisions, it can be irrelevant. They take each outcome, they multiply it by the probability, they add them up, and they get the expected outcome. And many people will say, well, we're going to take the course of action that has the highest expected value. But sometimes the expected value isn't even among the possibilities. Now, this sounds highly counterintuitive, but think about this. Let's consider a course of action which has 4 possible outcomes: 2, 4, 6, and 8. And let's say that we conclude that each of those 4 is equally likely to happen. So what we do is we take each one, 2, 4, 6, 8, we multiply it by 25%, the possibility of it happening, and we add it together. And in this case, the expected value of 2, 4, 6, 8 is 5. But 5 can't happen. Remember, I said the outcomes can be 2, 4, 6, and 8. So I'm only going through this to show you the possible fallacy of expected value. There's another problem with expected value, because even though course of action A can have a higher expected value than course of action B, course of action A may include some possibilities that you just can't live with. Maybe course of action A includes some remote possibility that you lose all your money. And even though it's highly unlikely, you may say, I just don't want to contemplate that. So you don't take A, you take B instead, which has a slightly lower expected value, but without the risk of ruin. Now, moving on a little bit to talk about the character of risk, I think it's interesting to note that risk is counterintuitive. They did an experiment in the town of Drachten, Holland. They took away all the traffic lights, traffic signs, and road markings. What do you think happened to the level of accidents and fatalities? It went down. How could it possibly have gone down when all the road aids were gone? And the answer is people said, oh, there are no more traffic signs, traffic lights, or road markings. I'd better drive more carefully. On the other hand, Jill Fredson is an expert on avalanches, and she said that better gear is created every year, which makes it easier and more feasible to climb, and yet the risk, the number of fatalities and accidents in climbing doesn't go down. How can that be? Obviously counterintuitive. People see that better gear is being invented, and they say, well, since we have better gear, we can do riskier things. And the level of accidents and fatalities is maintained even in spite of the arrival of better gear. So if you think about those two examples, you realize that the risk of an activity doesn't just lie in the activity in itself, but importantly, in how the participants approach it. The degree of risk present in a market or in an investment doesn't come just from the market or the investment, but how people participate in that investment. And if they conclude that the market has become safer, they may say that that frees them to do riskier things. And that's why I believe that risk is low when investors behave prudently and high when they don't. Just as risk is counterintuitive, I believe that risk is perverse. As I said, the riskiest thing in the world is the belief that there's no risk. A high level of risk consciousness, on the other hand, tends to mitigate risk. So when people say, well, that's really risky, if they take a cautious approach, then it becomes safe. As an asset declines in price, most people say, oh, it's risky, look how it's falling. But with the lower price, it actually becomes less risky. As an asset appreciates, most people say, that's a great asset, look how well it's doing. But the rising price makes it riskier. So again, perverse. And this perversity is one of the main things that render most people incapable of understanding risk. I think it's important to grasp a concept. Risk is hidden, and risk is deceptive. Loss is what happens when risk, the potential for loss, collides with negative events. You know, Buffett says everything the greatest, and he said that it's only when the tide goes out that we find out who's been swimming naked. It's only in times of testing that investors and their strategies are examined for the risk they really held. An example of that I wrote in my book, The Most Important Thing. Those of us who live in California, as I did at the time, our houses might contain a construction flaw. But if all is well, that flaw sits there for year after year and doesn't produce any loss. It's only when the earthquakes occur that the house is tested and the flaws are disclosed and the risk, the potential for loss, turns into actual loss. So similarly, an investment can be risky, but if it only exists in salutary environments, it may look like a winner for a long time, and it may look safe for a long time. The fact that an investment is susceptible to a risk that occurs extremely rarely, what I call an improbable disaster, what Nassim Nicholas Taleb called the black swan in his excellent book, the infrequency of loss can make it appear that the investment is safer than it really is. And of course, that's an entirely risky conclusion. So the infrequency with which risk turns into loss can be deceptive and cause people to underrate the risk involved in an activity. One of the most important things for every investor to learn is that risk is not a function of asset quality. This, too, sounds counterintuitive. There's a belief that high-quality assets are safe and low-quality assets are risky. I believe quite the opposite. A high-quality asset can be priced so high that it's risky. I came to work in this industry in September of 1969. The banks at that time, and I was hired by one of them, engaged in what was called Nifty 50 investing. They invested in what were considered to be the 50 best and fastest growing companies in America. Companies so good that nothing bad could ever happen, and there was no price too high for their stocks. And if you bought those great companies the day I got to work in September of 1969, and if you held their stocks tenaciously for the next 5 years, you lost more than 90% of your money because the prices paid were just too high and unsustainable, and roughly half of those companies did run into serious fundamental problems. Their quality alone, or their perceived quality, did not impart to them the safety that people thought it would, and in fact, because people thought they were so safe, they bid them up to prices which in fact made them risky. On the other hand, a low-quality asset can be cheap enough to be safe. Again, this seems counterintuitive and maybe even perverse. When I left the world of equities in 1978, I was asked by Citibank to start their activity in high-yield bonds. And now I was investing in the lowest quality public companies in America and making money steadily and safely. The juxtaposition of these events taught me an important lesson that I want to share with you so that you don't have to learn it firsthand. My conclusion was, it's not what you buy, it's what you pay. And investment success doesn't come from buying good things, but from buying things well. And if you don't know the difference, you have to study up. There are no assets that are so good that they can't become overpriced and dangerous. There are very few assets that are so bad that they can't be cheap enough to be attractive as investments. So this is a simple concept, it sounds like to me, but I hope you'll spend a lot of time thinking about its consequences. Now let's talk for a while about the relationship between risk and return. This is one of the most important of all the topics. When I got to University of Chicago, the Chicago School of Theory with regard to investment had just been developed mostly between 62 and 64, and I arrived in 67. And there was a graphic that we saw all the time. It shows return on the vertical axis, risk on the horizontal axis, and an upward sloping line to the right. We call that a positive correlation. One goes up, the other goes up as well. Now, most people would look at that graphic and say, well, that means two things, that riskier assets have higher returns, and if you want to make more money, the way to do it is to take more risk. I think that's a terrible formulation. Very simply, if it were true that riskier assets produce higher returns, then they wouldn't be riskier, would they? So that can't be the right explanation. What the upward sloping line, the positive correlation, means is that investments that are perceived as being risky have to be perceived as offering higher returns to induce people to make those investments. That makes perfect sense. The only thing is they don't have to deliver. And it's from the possibility that the projected returns will not be delivered that the risk ensues. When you look at the old graph, the linearity of the relationship between risk and return implies a dependable relationship. And I've always felt that that was misleading. I was never happy when I got out into the real world and had to live with the consequences. And so I developed my own version of that chart. I took some little bell-shaped probability distributions and I turned them on their side and I superimposed them on the same line. It's the same underlying line, just now with some embellishment. With the old graph, as you moved from left to right, the risk increased and the return increased. But with this new graph, as you move from left to right, the expected return increases just as it did in the old one, but at the same time, the range of possibilities becomes wider and the worst outcomes become worse. That's risk. This is the way to think about the risk-return relationship. So now let's talk a little more about how risk should be handled. What determines investment success? And the best way I have to communicate this to you, in my opinion, is like the act of pulling one lottery ticket, the outcome, from a bowl full of lottery tickets, the full range of possible outcomes. As Dimson said, we're going to have one outcome. There could be many outcomes. And the outcome that occurs never amounts, in my opinion, to anything but one ticket pulled from among the many. In my opinion, superior investors have a better sense for the tickets in the bowl, for what proportion of them are winners and what proportion of them are losers, than do most other people. That's what makes them superior. And thus, they have a better grasp of whether it's worth participating in any given lottery and how heavily to bet. Now, how should each of us deal with risk? I think that risk is best assessed through subjective judgment. Since risk cannot be measured, gauging it has to be the province of subject matter experts. And I'm clearly jaundiced on the subject of quantification. I believe imprecise, qualitative, expert opinion about the probability of loss is far more useful than precise but largely irrelevant numbers concerning past and projected volatility. So, what is the essence of risk management? Peter Bernstein, again, my hero. He said, because of the existence of risk, things are going to be different from what we expect from time to time. How well are we prepared to deal when it's different? This is a great formulation. There's no challenge dealing with the events when they turn out as we expected. The question is, are we prepared for when they don't turn out as expected? According to Bernstein, risk just means things are uncertain. Good things can happen as well as bad things. But I think the definition of risk should emphasize the bad things. And thus I would say risk is the possibility that from the range of uncertain outcomes, an unfavorable one will be the one that materializes. It can consist of suffering a permanent loss of capital when bad things happen. It can also consist of missing out on gains when good things happen. These things have to be balanced. Let's say you think that if you buy something today, there's a 1/3 chance it'll be down in 6 or 12 months. What will you do about that risk? Many people will say, well, I just wouldn't buy it. But what do you do about the other 2/3, the chance that it'll be up in 6 to 12 months? How do you balance the two risks? And, in the real world, we can't make decisions in one dimension. We basically have to balance. I think that risk is something that should be dealt with constantly, continuously, not sporadically. That's why I bridle when I hear this formulation. Is this a risk-on market or a risk-off market? Remember, risk produces loss when bad things happen, and that's when we need risk control. But I believe we never know when bad things will happen, and thus when risk control will be needed. I think the right model for thinking about whether we need risk control isn't American football, it's soccer. In American football, the team with the ball has the offense on the field. They have 4 tries to go 10 yards. If they go 10 yards, they get 4 more tries to go 10 more yards, and if they can keep doing it, they eventually score. But if the team doesn't go 10 yards in 4 tries, the referee blows the whistle. The ball goes over to the other team, and they try to go 10 yards in 4 tries in the opposite direction. So we have 2 teams switching between offense and defense, changing personnel when there are stoppages. That has nothing to do with the real world. The right model, as I say, is what the rest of the world calls football. The same 11 people mostly play the whole game. Nobody tells you when to be on offense or defense, and there are very few stoppages in which to adjust tactics and personnel. That's the real world. In investing, one of the key decisions is when to be on offense, when to be on defense, how much to allocate to each of those. But nobody tells you when to do it, and nobody stops the game to give you time. I think the best model for investing and risk management is automobile insurance. We all drive, we all have cars, we all have insurance on our cars, But I don't think any of us get to the end of a year and say, I wish I hadn't had insurance because I didn't have an accident. We like having insurance for the safety it gives us, regardless of whether or not we have an accident in a particular year. I think about the intelligent bearing of risk for profit. Back in 1981, I was interviewed by one of the first cable networks, and the reporter said to me, how can you invest in high-yield bonds when you know some of them are going to go bankrupt? And for some reason, I was able to come up with the right answer on the spot. I said, the most conservative companies in America are the life insurance companies. How can they insure people's lives when they know they're all going to die? And I think it's an interesting question. But the life insurance company is, number one, taking a risk that it's aware of. They're not shocked when somebody dies. That's the way it goes. Number two, they take a risk they can analyze. And when I was a young man and got my first insurance policy, they sent a doctor to my house to see if I was healthy. Number three, they take a risk that can be diversified. So no life insurance companies insure just smokers or just people who live on the San Andreas Fault or just skydivers, just young people or just old people. They have a mix, a diversified portfolio, and they take a risk that they're well paid to bear. They figure out the probability of what they're going to have to pay you based on actuarial assumptions. They allow some windage for the uncertainty, and then they charge you a premium. We do the same. We take credit risk that we're aware of. We analyze it. We take a risk that we can diversify. We have large numbers of holdings in every portfolio which respond to different factors, and it's a risk we're well paid to bear. We get what's called a risk premium or a yield premium to take the risk of default. So the bottom line is that I believe risk is kept under control in superior portfolios. That's one of the things that superior investors do. Highly skilled investors assemble portfolios that will produce good returns if things go as expected and resist declines if they don't. This asymmetry is, in my opinion, the critical element, the cornerstone of superior investing. Assembling a portfolio that incorporates risk control along with the potential for gains is a great accomplishment, but it's often a hidden accomplishment because risk only turns into loss occasionally when the tide goes out. But the prudent investor, and hopefully his or her clients, knows that risk is being controlled even at times when it doesn't come to the surface. So I think that risk is something to be managed and controlled, but not avoided. Risk control is indispensable. Risk avoidance is not an appropriate goal in investing. Will Rogers said, you've got to go out on a limb sometimes because that's where the fruit is. I think, and my experience tells me from watching others, that risk avoidance equates to return avoidance. Intelligent bearing of risk should be able to enable us to make good returns with the risk under control. So, what's the bottom line of all the foregoing? You shouldn't expect to make money without bearing risk. You shouldn't expect to make money just for bearing risk. Risk is best handled on the basis of accurate, subjective judgments made by experienced, expert investors who emphasize risk consciousness. The great challenge in investing is to limit uncertainty and still maintain substantial potential for gains. And in conclusion, I'll just say that outstanding investors are outstanding for the simple reason that they have a superior sense for the probability distribution that governs future events, the tickets in the bowl, and for whether the potential return compensates for the risks that lurk in the distribution's unattractive left-hand tail. This is what enables them to achieve the asymmetry that characterizes superior investors, participating strongly in the gains when there are gains and avoiding many of the losses when there are losses. I hope the foregoing discussion will help you be among them.
And that will do it for Global Money Talk live from the New York Stock Exchange. We are so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll be back tomorrow morning. Have a great day.